Welcome back to FS Page, your go-to source for mastering forex trading strategies. I'm Sonny, and today we are diving into the three main groups of chart patterns: continuation pattern, reversal pattern, and bilateral patterns. By the end of this video, you will know how to spot these patterns, understand what they signal, and use them effectively in your trading. Let's get started. Why chart patterns matter? Chart patterns are a visual representation of price movements that reveal the battle between buyers and sellers. Recognizing these patterns helps traders anticipate price direction, manage risk, and optimize entry and exit points. Whether you are a beginner or an experienced trader, mastering these patterns is crucial. Group 1. Continuation patterns. First up is continuation patterns. This indicates that the current trend is likely to continue after a brief consolidation period. Key examples include flags. Flags are small rectangular patterns that slope against the prevailing trend. Pennants. Pennants are similar to flags but with converging trend lines forming a triangular shape. Then we have rectangles. Rectangles are horizontal trading ranges indicating indecision before the trend resumes. Spotting these patterns early allows you to ride the trend and maximize your profit. Group 2. Reversal patterns. Next we have reversal patterns. This signal a potential change in the current trend. Some of the most reliable patterns include head and shoulders. Head and shoulders are a classical reversal pattern that appears at the end of an uptrend. Then we have double tops and bottoms. Double tops and bottoms indicate that the price has hit a strong level of resistance or support. Then we have rising and falling wedges. Rising and falling wedges point to a reversal after a period of consolidation. Understanding these patterns helps you exit losing trades early or catches the beginning of a new trend. Group 3. Bilateral patterns. Finally, bilateral patterns signal that the market could break out in either direction. They are perfect for breakout traders. Key examples include symmetrical triangle. Before we go on, to enable more traders like you see this video, please like this video. And if you want to see more videos from me in the future, please subscribe to this channel and turn on notification. In symmetrical triangle, price converges with no clear trend direction. Ascending and descending triangles. Ascending and descending triangles show potential breakout based on support or resistance levels. When trading bilateral patterns, always wait for confirmation before entering a trade. Combining patterns with other tools. Chart patterns are most powerful when combined with other indicators like volumes, moving averages, or trend lines. For example, a bullish breakout from a triangle with rising volume adds more confidence to your trade setup. Always confirm with additional tools to avoid false signals. Personally, I don't use indicators in my trading. And as you can see from this Bitcoin trade on H4 time frame, this is a double bottom trade. And as you know already, a double bottom is a bullish setup. So I've been in this trade now, and as you can see, I'm not that far off. Though price is retracing, but price don't always go in a straight line. It moves sideways before it gets to where it can go to. So this might be a correction, or it might be a reversal. Whatever it may be, I'll be watching this closely. So I don't use indicator. I also have another trade going. I shared this on Forex Factory yesterday, and I also uploaded it to YouTube. So if you already subscribed to me, check your notification. I believe you'll see this setup there. So I entered this trade on M30, and this was the breakout. After I entered, price came all this way, and there was a sell-off to this point. After that, a news came out about Trump saying something about tariff, and after that, price rallied to this point. But as it is now, price has come this low, and there is a bit of a correction now. So hopefully it will continue down. I also have another trade on GBP Aussie, which is also a bearish flag like the previous one. And here was the breakout. After I entered the trade, same situation as the previous one. So let me not dwell on this. And I also have another trade on Euro USD, which is a triangular pattern. As it is now, price is not going the way I want it to go, but hopefully it will head down because the breakout was to the downside. But the tricky situation here is that this could be a fake out. If this is a fake out, then once price closes above this point, I will be exiting this trade. As it is, from my previous video, I told you that a triangular pattern can be a continuation pattern as well as a reversal pattern. But as it is, price has already broken down to the downside. And after price got to this place, it has retraced up to this point. So it might head up. If it heads up, then I'll be exiting at this point, and I'll be changing my bearish bias to bullish bias because this is also a breakout as well as this. So I'll be watching this carefully. But since the breakout was to this point the first time, I'm hoping that it will head south. I also have another trade running on CAD yen on the daily time frame. This is also a flag, but I'm trading in the channel of the flag. So by the time price gets to this place, I will exit this trade. As it is now, I'm not that far from my target, but once price gets to this place, I'll be looking for opportunity to go short. I also have another trade which is currently going on silver. I took this trade before I started recording this video, and as it is, I'm already in profit. So from all that I've shown you, you can see I did not use indicator. I depend mostly on support, resistance, the trend, and what the price action is saying. If you'll be watching my videos and if you'll be seeing my uploads on Forex Factory, you will know that I always respect price action. Price action tells you what is happening. It does not depend on any lagging indicator. So I'll advise you to train yourself on how to use price action. Common mistakes to avoid. Before you start trading chart patterns, avoid these common mistakes. 1. Trading every pattern you see without confirmation. 2. Ignoring the broader market context. 3. Overlooking false breakouts or relying on patterns alone. Remember, patience and discipline are key to successful trading. Now that you know the three main groups of chart patterns, it is time to put this knowledge into practice. Watch my tutorials on specific patterns to deepen your skills and boost your confidence. Don't forget to like, subscribe, and turn on notifications for more trading insights. Thanks for watching, and I will see you in the next video.